Good afternoon, my name's Craig Earlham, market analyst at Alpara UK, and welcome to our daily update on the markets. Today, unsurprisingly, the main story in the markets has been that bailout of the Spanish banks. The details of the bailout are not entirely known. We don't yet know if the bailouts come from the ESM or the EFSF. We believe the bailout is roughly around 100 billion euros, and the interest rate again is believed to be between around 3 and 4%. However, again, there's no details being confirmed yet. But I don't really think that's made of having much of an impact at this moment in the markets. Stocks are trading much higher today. We've seen the FTSE trading up around 1%. We've seen the European indices, the CAC, the DAX, all trading up around 1.5%. And the IBEX, the IBEX opened 5% higher this morning, although all the stocks have retraced back a little. The IBEX especially is retraced back now and is only trading higher by about 2.5%. But again, very good news for the markets. It shows that the Eurozone leaders are taking concrete steps and showing that they are committed to resolving the Spanish banking crisis, and that has been shown by this agreement. The good news for the Spanish are, because this is a bailout purely for the banking system, although it has to go through the Spanish books and go onto their government debt, so the taxpayer is still liable, the good news for the Spanish government is there's no austerity measures connected to it, because the work they've put in over the last 5 months with the cuts and to shore up their books, there is no further austerity measures associated with it, so it does make it slightly different from the Irish and the Portuguese and Greek bailouts we've seen over the past 2 years. So again, this is very good news for Spain, and we did see their bond yields come back as a result of that, come back closer towards 6%, although again, we have seen it retrace back now and it's moved up to around 6.2% in the markets. But again, compare that to earlier in the month, and compare the overall feeling in the markets now compared to even last week. You've got to think that there's a lot better feeling in the markets, there's a lot more improved sentiment in the markets, and there's a lot more confidence as a result of this in the Eurozone leaders to pull out of this crisis. Now, I know we were only expecting these results towards the end of the month once we had the results of the audit, but it is now believed that the reason why we've seen this bailout occur so early in the month is because of the Greek elections on the 17th of June. Now, it is believed that the Spanish banks would not have had the capital to withstand a Greek exit from the Eurozone, which would lead obviously to a Greek default on their debt. So this is believed to be the reason why this deal has been pushed forward to this weekend as opposed towards the end of the month. But again, that's not very important. I mean, a Greek election isn't looking overly likely now. We have seen other parties take the lead. We've seen New Democracy move into the lead over the last couple of weeks. So it's not as certain anymore that there is going to be a Greek exit in these elections. However, this does now add more confidence to the markets that if there is a Greek exit from the Eurozone, that the Spanish banks would be able to cope with that, and therefore the contagion wouldn't move from Greece to Spain and maybe further on to Italy and France, etc. So this is very, very good news for the markets. Now, there is likely to be a lot of uproar from this, because as we do try to move away from the fact that banks are too big to fail, as people are saying, and there's a lot of anger in the market saying that basically we thought that we weren't going to bail out the banks anymore. If the banks fail, then it should be, this is just how it should be, this is just how it should work. I do believe that it would be the wrong time to allow these banks to fail in Spain. I do believe that the contagion that would have resulted from these banks failing in Spain would have been much greater than the 100 billion bailout that we have seen from it. So again, there is a lot of improved confidence in the markets. It is a model we need to move forward to look more towards in the future. But again, I do believe at this moment in time, the bailout was the best solution, not just for Spain, but for the Eurozone as a whole. And for a wider spread, I mean, this contagion has started to move further out. We saw Barack Obama on Friday say any further contagion in the Eurozone would eventually spread to the US, and they were concerned about that. We've seen it from Chancellor George Osborne last week, as well as Prime Minister David Cameron. So again, I do think globally that this was the best solution for everyone concerned. And although the Spanish taxpayers are still liable for this 100 billion, again, compared to a Spanish banking collapse, I do think it's by far and away the best option. We've also seen this have a positive effect on the euro in the currency markets. The euro moved back above 126 earlier today against the dollar. This has fallen back again slightly to around 125.50. But again, it's the first time we're seeing euro gains. We started to see it last week with the rumours starting to come out on Friday, especially about the potential bailout of the banks. And we're seeing it again today, so we should see the euro can move higher. But we do need to look out for these details, because there is a lot of details yet to come out about this crisis. About this bailout. We've also seen a movement in the cable charts. We've seen, as we mentioned on Friday, the cable charts on the weekly charts especially has been moving in an ascending wedge since around 2008. Now we're nearing the bottom of this wedge, so we either needed to see a bounce from this wedge, which we are starting to see at the moment, and we could continue to see over the next couple of weeks, or if we'd have seen a break below the wedge, we could have fallen right back down to around 125. We're currently trading at around 155, 156. So again, it looks like we are going to see the bounce off the bottom of this wedge, but if we see if any of the uncertainty in the Eurozone, especially surrounding the conditions of this bailout, do come out and do appear negative for the Eurozone and for the Eurozone recovery and for Spain or Greece, we could see this fall below the wedge, and then we could see this movement come all the way back down to around 125. That's all we've got for today, however. So my name's Craig Allen, market analyst at Alpara UK, and thank you very much for joining us.